Hence, our economy is crashing at high speed.
What Janet Yellen was saying, we all left Monday thinking that, hey, it's okay. The banks are going to be bailed out, and it won't be at the taxpayers' expense, which we all knew was a lie. It would be at your dollar's expense or your deposits' expense, in the respect that the money had to be created out of thin air, and we just figured that would mean more inflation. And so all of the banks, regardless of their poor choices, their gambling, if you will, in depositors' assets, and we'll talk about that in a moment, that they'd be bailed out, and that this would just be an ever increasing party of printing and of backstopping the banks. And what she said yesterday was truly shocking to me. So are you telling me then that all of the small regional banks in my state will be backed by the full faith and credit of the Fed, so that none of these banks are going, if they fail, they will all be bailed out the way that
Silicon Valley,
thank you, bank did, and the other one that just failed as well. Well, basically what she said was that the only banks that will be bailed out will be those banks that have the approval of the majority of the FDIC board, the majority of the Federal Reserve Board, and Janet Yellen herself. Those are the only ones that will be bailed out. In other words, those banks, she said, that in our minds are too big to fail, the systemically too big to fail banks. In essence, what she was saying was that all of those smaller banks are dead on arrival. They won't be bailed out. And if they're not deemed to be systemically important, then they will have no backstopping. And what that is basically doing is herding everyone into a pen of the 4, 5, 6 biggest commercial banks in the world, or in the United States, the Wells Fargos, the Bank of America, the Citi, the JP, the Goldman. All of them are going to be too big to fail, systemically too big to fail, interconnected with one another through a massive, massive amount of derivatives, whereby if they fail, they'll bring down the whole system. But the little banks who run into trouble, and we're going to talk about why they run into trouble in a moment, but those banks, no, they won't be bailed out, and too bad. And what that's going to do is collapse the entire small banking industry, the entire regional bank industry is going to collapse. Who's going to leave their money in these little banks? If you're running a business, those banks are not too big to fail. And if they go under because of the systemic nature of what is happening, they're not going to be bailed out. And it's important to understand something. So most of these banks have virtually nothing in the way of currency on hand. And because they would take these deposits that came in from the depositors, and they would buy bonds with them, typically treasuries, and in many cases mortgage-backed securities, at rates above what they were paying, of course, to the depositors, but in what was typically considered safe places to be. The problem is all of those bonds have an average maturity or an average yield rather of about 2 to 2.5% and long maturities. And so the problem is that since interest rates have risen closer to 5%, every one of those bonds in their portfolio have lost 50% or more of their value. Now, the banking regulations say that they don't have to mark those to market until they sell them. And so they have a whole balance sheet filled with toxic assets that have lost over half their value or more. So in the case of SVC, when you saw a run on the bank, for whatever reason, you get people running on the bank because there's so little cash, the reserve requirements have been slashed to nothing. These banks are forced to sell their bonds at a huge loss in order to meet customer demands to get their money back. And if enough people redeem or withdraw their money, and the banks are forced to liquidate their bond holdings, which have been eviscerated by rising rates, then as we saw last week, a large bank can become insolvent in less than 24 hours. And that's exactly what happened. The FDIC can't handle this. Their insurance fund is only 0.03% of bank deposits. 0.03%, roughly 125 billion in FDIC liquidity backing over 9.5 trillion in deposits. So if just one or two banks fail, that's it. That's gone.
Who's going to decide who lives or dies?
It will be her, the overwhelming majority of the FDIC board, and members of the Federal Reserve. So they're going to decide which banks are worth saving and which banks aren't. And we all know which banks they're talking about. These are the commercial banks. These are the banks that we are seeing billions of dollars flow into now over the last several days. People are yanking their deposits out of these smaller banks because they're terrified for exactly this. And when she said this, she admitted the fact that they are going to pick and choose as to which ones they believe are too important to fail and which ones aren't. This is going to herd everyone into these banks. Every one of the people who have large accounts at these regional banks are going to pull their money out and they're going to send it over to JP Morgan, to Morgan Stanley, to Citibank, to Goldman Sachs, because they know that those banks will not be allowed to fail.